The S&P 500 has done very well over the last year. We can see it's up over 26%. Because of its rise, we've seen the PE ratio creep slowly higher and higher, now into the upper 20s. Historically, the S&P 500 trades somewhere in the high teens to low 20s. So we are higher than normal. However, what I am not proposing to you is necessarily that you need to sell the S&P 500, liquidate your ETFs, sell out of the Mag 7. I think the Mag 7 is going to continue to do well over a long time horizon, 5+ years. There's no reason to sell. However, what I am proposing to you is that you are missing something. This market is missing something. And that specifically is companies that fall out of the threshold of the S&P 500. I'm going to make the case to, I think, some reasons why this is happening. But first, we're going to start off with companies that this applies to, so you can actually see what I'm talking about. Here are 3 companies that display what I'm talking about pretty well. So this is over a 10-year time horizon. You can make it 8, you can make it 12. The point and the numbers would still roughly stay the same. So we're comparing to the S&P 500, and here we have 3 companies, Insight, Fabrinet, and NICE. And we can see the return rates over the last 10 years, up 400%, up 1,000%, and then just slightly under the S&P 500's performance, which is up 165. So taking it at face value, these are companies smaller than they're roughly 10 billion market cap or smaller. So we would expect, okay, a company that's up 400% over that time frame, you would expect it to be slightly more than the S&P 500 at least. PE ratios, considering it's outperformed so dramatically, even if it is a smaller company, you would see that trend with a tech stock that has outperformed the S&P 500. There's very few that have outperformed the S&P 500 by this rate and that have PE ratios smaller than it. But let's take a look at where they are at. And Insight currently is at a PE ratio of 21.5 and forward PE ratio just under 16, compared to the S&P 500, like I said, which is in the upper 20s, and forward PE ratio sitting somewhere around 23. So here you have a company that isn't minuscule. They aren't huge, but they're at about over $5 billion market cap, and they are outperforming the S&P 500, more than doubling it over the time horizon, and they're significantly cheaper when you're looking at PE ratio. Let's take a look at the next one, Fabrinet. You're getting in the range of 6xing the S&P 500 performance, 20% year over year. Let's take a look at the company. Now, clearly they were really small, but even now where they're at $96.9 billion market cap, their PE ratio is just over 31.5. So you're only, 3 PE higher than the S&P 500 right now for a company that is in the realm of 6xing it. And then the last one, NICE. You're up 141%. Okay, you would expect it to be slightly under the S&P 500. However, they still are pretty dramatically below the S&P 500 when you're looking at forward PE, 13.5. You're nearly half the S&P 500, which is at about 23. This is a trend I'm seeing with smaller tech stocks constantly. It's not just these 3. If you do think it's just these 3, go ahead. Buy these 3 because obviously they have lower PE ratios. They're cheap. They're going to continue to grow relatively fast. At least that's what they should. That's what history tells us. You'll make a lot of money, then you give me some because I showed these stocks to you. No. I would love that, but that's not the point of this video. This is a thing that is happening. This is true. This is across multiple stocks. It's not just these 3. These 3 is just to illustrate the point. And we can see that if we're comparing to the S&P 500 to the Russell 2000. This is their performance over the same time horizon. We can see for the most part, it was roughly the same. They went almost in lockstep. Then we can see before COVID, there was a bit of a difference, but even early 2021, they were roughly the same, like literally the same over this 10-year time horizon. We can see as recent years, lows in 2022, and then now we're sitting at today. There is a dramatic difference, 164% compared to 62%. Annualized, that's under 5% compared to over 10. That is interesting. Why are we seeing that now? Part of the reason is the Mag 7. Absolutely dominant. Also, you're just more likely to hold the S&P 500 in a retirement account. That's becoming more and more common. Obviously, it's always been common, but even more so. A lot of people online, if you look online advice, just buy the S&P 500, it's outperformed compared to the others, compared to like a broad market. And you would expect the top companies to outperform. However, because so many people are pouring money into these smaller stocks, because there's not a lot of people doing research on these. Of course, it's so much easier. I'm just going to buy Amazon. You know about Amazon. You know about Apple. You know about Nvidia because everyone talks about how well it's done. You know about these stocks. Every single person watching this video knows about these stocks. How many people clicking on this video knew about these three? There's probably a couple hundred people watch this. You've probably heard of some of these. Most of you haven't heard of most of these, and almost none of you have heard of all three. You just aren't seeing it. The market is missing it. The market over a long term is going to provide return depending on how well companies do. But in the short term, it's not always correct. There's many things the market gets quote unquote wrong. And it gets it wrong because it's not seeing the full picture. You know, you could look at a 1-year performance and say, okay, that's just, hey, we're going to do good this next year. But they aren't looking down 5 years down the road. They can't see that far. I truly believe the market is missing these stocks, and they're missing stocks similar to them. I haven't had time to dive super deep into these stocks in this video because that's not the entire point, and I don't have that much time. You guys would click off. But all these stocks do important tech stuff. Nice, specifically. The reason they're here, and they're only up 141%, is because they haven't grown over the last 5 years, but they've doubled their profitability. They've doubled their earnings per share in the last 3 to 4 years. Their PE ratio is higher, so you don't see that necessarily reflected in the share price. All these companies are tech stocks. They're in important spaces. NSIT does a lot of software. They do some AI integration stuff. It's an AI tech stock that has gone up 400%. That is valued under the S&P 500 dramatically. The market is missing stuff. Now, are all these companies going to outperform long term? Who knows? I'm not saying they will, but I'm saying there are companies like this, smaller, let's say somewhere between 15 and lower billion-dollar market cap tech stocks that are performing well, that are significantly cheaper. And yes, there is some risks associated with smaller PE. You don't know as much about the company. I know a lot about Amazon, even if you don't research the stock, you know about it. I don't know much about these three. However, that shouldn't indicate a half valuation to the S&P 500, a 15 PE or like a 13 forward PE compared to a 23. The difference is just too dramatic. It just is. The market, in my opinion, is missing it here. But if you guys disagree or agree, let me know down in the comment section. I appreciate all of you for watching this video. If I taught you something, leave a like, subscribe. I do daily stock content on this channel. I appreciate all of you for watching, and I'll catch you next time.